For the next 10-ish, 15 minutes, I want to bring up some of the members that we have built, because we have this structure in place, and we've been able to create that within our own environment at Big Life Financial. But I want to bring some of them up so we can ask questions around, maybe it's tax specific or maybe it's wealth management specific, but feel free to ask questions on what does the nature of collaboration look like? How do we set this up? If you have specific questions around like, what should I invest in? We're not going to get there, but if it's broad strokes, we can answer lots of different questions around how to go about doing that. So just raise your hand and we'll get you a mic, and then you can ask your question, and we'll do our best to answer it.
So I have a question about what to do when you get a big lump sum of money. Like, for example, we have somebody who's about to prepay for a chunk of tuition for next September, so about $100,000, $80,000 to $100,000, and I want it to go somewhere that is accessible if I need it, but that's doing a lot more than just sitting in like nothing happening savings account.
Can I answer that one? And let me just kind of explain the relationship here. So where I come into the picture here with Justin Maxwell and Big Life Financial is down here on the left-hand side where it says RIA. I act as the arm to Big Life Financial that deals with the alternative investment space, with the private investment space. How do you get tax savings through different types of investments? Now, when it comes to this question of where do I put my money right now that is still liquid, that it's a short term, that it can still grow, the beautiful thing with that is right now in today's environment, for the first time in about 15 years, we have a lot of options. Whether you're the money's sitting in a bank and we can look at CDs or something like that that can give an interest rate of, or even a guaranteed rate of a certain percentage, 4, 5, 6%. Or there are places within the private marketplace also that will give you that 5, 6, 7%, where maybe it's a type of a strategy where your money is acting as private financing. And that's being loaned out to contractors that are trying to get bridge loans or something like that. It's called a private debt strategy. But there are a lot of options within that space that you can still get pretty close to saying the word guaranteed, although we don't say that here, pretty close to a 5, 6, 7%, which, you're right on track or maybe just a little bit ahead of what inflation's going to do to the money right now. But if your money, and this is something that you should think about even with your business checking accounts and anything else, if your money is sitting there and it is growing at 3% or less, there's something else you can do. All that you need to do is just make a phone call to your banker and just say, I need a high-yielding savings account. I need your highest yielding money market fund. I need something else that's going to grow at a 4, 5, 6%. And they should even be able to get you that. Great question.
How long a time do you need? Like, is that something that's only valuable to do if it's, like in my case, it's almost a year? Or is it like, well, if it's 3 months or more, is there some kind of timeline that we should be running that through in terms of the money sitting there, in terms of making that a valuable step to take?
Yeah, great question. If it is anything that's ever less than 12 months, then it does need to be a product that is a same-day liquid type of a product. Okay, if it's ever more than 12 months, then you can start getting into strategies where you have to have it in there for 12 months. There will be a 12-month hold, and then it's redeemable after that. And the reason why they do that is because those groups don't ever want to have to deal with short-term capital gains. So they just force it on you to say 12 months, otherwise we don't want to deal with the accounting.
What are your thoughts on things like 501c7s or pastoral medicine associations and things like that for obvious tax reasons?
And is that the one where it's a donation strategy with it, or?
It's a membership program.
Great question. What I'm going to say to this is I don't know the details of that. I do have some of my clients that are in that. When you're using any kind of a tax code as a tax alleviation, number one, applaud yourself for finding it and using it and following it to a T as closely as you can, making sure that your CPA is also on board with it and may have come from the CPA. If you have a CPA that you've brought it to your CPA and they're just like, oh my gosh, I don't know.
Yeah, they don't know.
Right, and usually they'll come up with this excuse of, oh, you're increasing your audit risk, so we're not going to do it. That's where you personally need to research it a little bit more because we should never run away from a tax code if it exists. Sure, great. I think every high net worth individual should go through an audit at some point in time. Otherwise, you've given away too much money to the government. And I'm not an anti-tax person, but let's use the tax code. So just make sure you've got the right, if your CPA is unwilling to look at it with you, but you still like your CPA, go to your CPA and say, hey, if I pay for 3 hours worth of your time.
Don't know.
Yeah, great question.
The only thing I would say around anything charitable is sometimes people will chase charity in the hopes of a tax deduction. It should be I'm chasing charity to be charitable, and the tax deduction just happens to follow behind it. So I get the benefit is the charity, and I'm just getting the tax benefit because I'm being charitable. If you chase it the other way, you can run into issues with the IRS. So
This is a membership program.
Okay.
Yeah.
So I've used the R&D credits before, and I was understanding those are kind of sunsetting or going away.
No, they're not. They're not going away. So because so many people aren't proactive, if you don't proactively plan with them, they're going to be less effective. Like you're going to lose, like let's just say you could have saved 50,000 in R&D credits, like the total net benefit will probably drop to like 42 or 40. So you still have a benefit there, but you're not getting the maximum value for it. But if you had planned with your accountant during the year to potentially move some expenses around to get your expenses up in one category, the R&D credit can fit really nicely into that bundle of planning. It's not going away, it just changed the way it's accounted for. Most accountants are too lazy, or not lazy, but they don't want to go to the work to go to that level of planning, similar to what's happening here, where that's too much work for me to know, so I'm not even going to touch it, because I'm good with what I'm doing.
Yeah, with that said, though, there are a lot of things that are sunsetting this year. So make sure you're talking to your CPAs, your tax attorneys, whoever else. A lot of the 2017 jobs and CARES Act of Trump will sunset. So if there's anything you need to put into place now, like slats or anything else like that, talk to your attorneys, talk to your CPAs. Yeah.
Hi, just a question. It seems that if you get into more of these complex and alternative strategies, number of people involved goes up, amount of fees go up, and paying a 30% fee on like a tax credit might make sense because it's all credit, but a 3% fee on a long-term investment can really eat away at long-term. So what questions should we be asking our tax person about fees and how to consider those as we go into these complex investments?
Yeah, that's a great question. So the way I would view it is you can put on paper like how much you're going to save if you do X strategy, and then you can calculate the expenses, and as long as you're getting a ROI or you're saving more than the fees cost, it's probably worth having another conversation. But you can also find people that do things cheaper, like 3% on investment stuff is really expensive, and it probably shouldn't be. That's going to be too much over the long haul. But I would be looking more in the 1%, 1.5% range at most for fees for anything that's asset under management based. Would you?
Yeah, if we're talking the investment space, then I'll go back to the tax space. When you slice and dice fees, especially within a financial advisory firm, you're always going to pay somewhere between 1% to 2% in fees. It's just the way the profits margin work with an RIA, with a registered investment advisory firm. So ask the advisor, what are your management fees and what are your advisory fees? And if it's more than 2%, then you got to negotiate something lower. That's the other thing to know. You can always negotiate, okay? Because they say it's a certain amount, and there is room to negotiate, depending on how much AUM you're willing to bring over, how many people you bring over to their firm. Make sure you're working with that, because you're right, 3% over 20 years, it really does start to add up, so watch for that. On the tax side of it, the tax industry is really starting to change right now. Most CPA firms at this point in time are starting to go more to a subscription-based model, where you're paying somewhere between, depending on how many entities you have, somewhere between $150 to $500, $800 a month. So talk to them and get a list of what are the values that they're providing you, and really just start to vet that out. And don't get sold just by the first person you talk to. Make sure you talk to 2 or 3 people so you understand what's happening there. If it's ever on the insurance side, it's always commission-based. It's just the way the insurance world works. Okay.
We have time for one more.
So kind of piggybacking off the point of like paying for different entities, using Wyoming, setting up a Wyoming account as a pass-through, or maybe for other reasons, is it worth keeping that if you have it, because my understanding is you can't get them anymore. I don't know if I'm correct on that, but I am trying to, this is a personal tax question, but I want to hold on to it because if it's going away, I want to have it, but then if I have to pay for that, is it worth holding on to if I'm not actually using it right now?
Still pay the $80, $100 a year to keep that alive, to keep that entity going. It's going to shift back and forth, determined by who the president is, who Congress is. So we will see, you're right, it is sunsetting right now. If Trump gets into office, it'll probably open up again. And that's not a political statement. I'm not a support of either political candidate. I'll tell you that much. I'm very much independent. I'm very much moderate. But if Trump is in, those will probably be resurrected again. So hold on to it just in case there is something that you do get grandfathered into if a President Harris is in office. Okay?
Thank
But
you.
yeah.